Hi CA students, let's revise CA Final AFM Chapter 5 Security Valuation. Practical question 2. ABC Limited shares are currently selling at 13 rupees per share. There are 10 lakh shares outstanding. The firm is planning to raise 20 lakhs to finance a new project. The requirements are: what are the ex-right price of shares and the value of a right? If the firm offers one right share for every 2 shares hold, so in the ratio of 1:2, and what if the firm offers one right share for every 4 shares held, which is 1:4 ratio? Then the third requirement is: how does the shareholders wealth holding 100 shares change from 1 to 2? How does rights issue increase shareholders wealth? Actually it will not increase shareholders wealth, so but still we'll solve the question. So going further, first to find out the X right per share. So what is X right price of a share? X right price of a share is nothing but after the share issue happened, how much the share value has reduced and what is the price after the rights has been issued. So ideally when a share is issued at a discount price, so in case of right shares, the shares will be issued at a discount price, the overall value gets spread out across the new shares issued, so the price adjusts downwards. So the new adjusted price is called the ex-right price. So going to the solutions, we need to find out first how much new shares are issued. For that, in the first requirement of the question, we have to take 1:2 ratio. So the existing shares are around 10 lakh shares. So the ratio is 1:2. So people holding 10 lakh shares will get around 5 lakh shares now. So this will be the number of shares to be issued in case of the first requirement. The subscription price will be so we need to know how much price will be the right like how much will be the new shares issued for right. The firm is planning to raise 20 lakhs, so 20 lakhs divided by shares will be 4 rupees, so that will be the subscription price. And the X right price, how will we find out? So the existing shares, which is 10 lakhs, into the current selling price, which is 13, plus the new raised funds, which is 20 lakhs, divided by the post issue. So post issue existing 10 lakh plus new 5 lakh, right? So we will get the average route price of rupees 10. This will be the X right price. Now we need to find out the value of right per share. So since the subscription price is 4 rupees and the X right price is 10, so 10 minus 4 will be the value of right, which is 6 rupees. Now per share, how much is the value? So 10 minus 4 divided by 2, since for every 2 shares one right was issued, so the value of right per share will be 3 rupees. Now going further, the second requirement, same way we will be solving the second requirement also, but in the second case it is 1:4. So the subscription price also will change and even the number of shares to be issued also will change. So in the second requirement, number of shares to be issued will be 10 lakh divided by 4. So 2,50,000 is nothing but 10 lakh divided by 4. And X-rate price, as the same we have seen, the existing shares into existing selling price 13 into 10 lakh plus the newly raised funds 20 lakh divided by post issue shares, which is 12 lakh 50, 10 lakh plus 2 lakh 50,000. We are getting a X-rate price of rupees 12. So the value of right will be rupees 12 minus the subscription price 4. And value of right per share will be, since for every 4 share held, one right share is issued, 12 minus 8 divided by 4 equal to 1. So the value of right will be 1. Now going to the third requirement, which how does the shareholders wealth holding 100 shares? Let's say if a person is holding 100 shares, how his wealth will shift from 1 to second. So first we have to find out the wealth of 1 and then wealth of 2 in the given scenarios. So the X right price of the share is 10 in case of first requirement, So 10 into the current shares. So post issue, the shares will obviously increase, right? Because we will opt for the rights issue. Since a person holding 100 shares, in case of first requirement divided by 2, we will get 50. So 50 shares will be added to the existing shares. So 150 is nothing but 100 plus the newly applied right shares. So 100 plus 50, 150 into the post X right price, which is 10. So our value is 1500, and to acquire this 50 shares, the shareholders are paid 4 rupees, which is the subscription price here. And reducing that, since we spent this 200, right, we have to reduce it. So the wealth of the shares is 1300. Now in the second requirement, since it is for every 4 shares 1 right was issued, so 100 divided by 4 equal to 25. Now this 25 will get added to the existing 100 shares. 125 into the X right price of is 12 rupees. So 125 into 12, which is 1500. Same, to acquire this 25 extra shares, we have paid 8 rupees subscription fees in the as per the second requirement. So 25 into 8, 200, which you have to reduce. Reducing that, the value will be 1300. And even the wealth of the shareholders before the rights issue also will be 100 into 13 rupees, which is 1300. So in all the three cases, the value of the shares are not changing, value of the wealth of the shareholders are not changing. Thus there will be no change in the wealth of shareholders from 1 and 2, and even before the issue of the right shares also. Now, why the shareholders' wealth does not change after a shares issue? It is because even though the share price drops, we are getting more stakes, more shares at a discounted price. So total value stays the same. Thus, even after rights issue, the wealth will be same in all the scenarios. Thank you.